Hi class. So this week we are starting chapter 3. It's on capital structure and leverage. Alright, the main topics that we're gonna study today is business versus financial risk. So we're gonna learn in depth what is business risk and what is financial risk, and then what is capital structure and what is optimal capital structure. So capital structure means how do a company get financed? How do the company get financed? All right. So the financial structure is what we call as capital structure, and how do we get the optimal, the ideal range of capital structure? All right. And then next is operating leverage. All right, which is the usage of fixed costs, and then you have capital structure theory. All right. So let's move on to the next slide, where you can see something similar or something familiar. You saw this in your chapter 1, all right? One of the first beginnings slides, right? So this basically covers the entire topic in corporate finance. These are the main key core decision makings, and today's topic comes under financing decision, the second. All right, so here we can learn what is the optimal capital structure. All right, so today's topic, chapter 3, comes under financing decision. So remember what we learned in financing decision. How do the company raise the funding? How do they get the money for the company to operate, right? So if you can still remember, there are two major sources of financing, which is debt and also equity. All right. So what is the percentage of debt and what is the percentage of equity? That is what we call as capital structure. If let's say a company is funded by 50% equity, 50% debt, so that is the capital structure of a company. If it's 70% equity, 30% debt, so that is a capital structure. All right. So that is all about what you're going to learn in today's topic. So moving on, let's start with debt. All right. So what is advantages of debt? What is disadvantages of debt? I hope you know what is debt, right? It's a company borrowed the funding usually from banks, all right? Or company itself can issue debt in the form of bonds. So both are categorized as debt. So what is the advantage? So the first or one of the main advantage for debt is the tax. Okay, what is the tax? When you take a debt, when you take a borrowing, you have to pay interest. All right. If you take a loan, you have to pay interest to the bank. The interest is actually tax deductible. All right. So that's a good thing about interest. All right. When you take a loan, the interest is tax deductible. Therefore, your tax will reduce. It means when you take more debt and you pay more interest, the tax amount will reduce. All right, so that because interest is tax deductible, so it will lower the effective cost of debt. So remember, when we calculate cost of debt, KD, all right, we always minus tax. KD 1 minus tax. All right, we will learn this later on. So we always write KD 1 minus tax. All right, so that way we reduce the cost of interest, all right, or financing costs. Okay, so remember, interest is tax deductible. That's the main advantage of debt. Of course, you can say, what about equity? Don't we have any tax benefit out of it? For equity, all right, for shareholders, do you pay interest? No. you pay dividends. And does dividends got any tax benefit? The answer is no. Alright, there is no tax benefit, there is no tax deduction when you pay dividends. So that is why compared to equity, debt has the benefit of tax deductible. Alright, so you end up paying lesser tax. So your financing costs will reduce, right, compared to equity. The next one, debt holders are limited to a fixed return. So stockholders or shareholders do not have share profits, right? It means what? If you take a loan from a bank, you pay interest, and the interest usually is fixed. Let's say you take 1,000 ringgit, you just take 1 million ringgit. You have to pay 5% interest per annum. Alright, that 5% per annum is fixed. Alright, if you take 100 ringgit, let's say you have to pay 5 ringgit, that interest is fixed. You have to pay only fixed return. If the company makes double the profit or triple the profit, do you pay higher than 5%? Or do you pay double the interest? The answer is no. When the company is doing well or not, you still pay the fixed return. So that is another advantage. Alright, so shareholders do not have to be afraid saying that, oh, the company has to pay more interest when the company does well. Alright, so there's no such thing. Only shareholders will enjoy if the company perform better. Alright, if they have double the profit, then shareholders will reap the benefit, not the debt holders. Bank doesn't have anything extra from whatever they have agreed, the fixed return. Okay, and the third one, debt holders do not have voting rights. Okay, why voting rights is so important? Who does have the voting right? The shareholders, right? Shareholders are the only one who have the voting rights. And what is the use of voting rights? Alright, so in the annual general meeting, alright, the shareholders will have to vote whether they're going to re-elect the directors. Alright, if they doesn't like the board of directors, they can terminate and hire new board of directors. That means board of directors who run the company is being obviously controlled by the shareholders. Alright, debt holders have no right against the control of the board of directors. Alright, and another thing is, another benefit of having voting rights is any major decision making, the shareholders have to vote. Alright, if let's say the company wants to merge, okay, with another company, then they have to get voting rights. But debt holders do not have. That means debt holders cannot control the company. Alright, the only power is in the shareholders. Alright, so the voting rights is in a way is used to keep control of the company. Alright, so that is the advantages. So let's look about disadvantage. Higher debt ratios lead to greater risk and higher required interest rates to compensate for the additional risk costs, right? So class, when you compare the advantages of debt with equity, I say debt has a tax benefit. The interest you pay is tax deductible. So for a company, when you compare for the, let's say for the managers, directors, when you ask how are you going to finance your company, you want to take more debt or ask the shareholders to invest more, usually the directors or managers will say, all right, we'll go for debt, right? We'll try to maximize the debt because debt is cheaper cost of financing. So remember, debt is cheaper cost of financing because of the tax benefit. All right, but can a company keep on taking more and more debt since it's cheaper? All right, compared to equity, debt is always cheaper. So can we keep on taking more and more debt, more and more loan? All right, is it possible? The answer is No, right? The reason is when you take higher debt, it can lead to greater risk. Okay, what is the risk? As we mentioned earlier, your second advantage. If you look at the second advantage, the thing is debt holders are limited to a fixed return, which means the company performs well, you still pay the same interest, right? But on the other way, on the other way, the other way around, if the company does not perform well, if the company making loss, will they pay less interest or will they ask the bank, all right, since the company is making loss, can I pay next year? All right, there's no such event could take place. Banks or the lenders will not give you any flexible time for you to take on sweet time and to make the payment later. All right, even though the company does not perform well, they have the liability to make the interest payment or paying back the capital on time, right? So the problem here, when your company has, let's say the company has 90% funded by equity, 10% funded by debt, which means your fixed liability, all right, your fixed commitment, the interest payment, the fixed commitment is low, so you can uh, able to take the liability, all right, because the amount is still low. But if you keep on taking more and more debt from 10%, 20%, 30%, 40%, which means only 60% funded by equity, 40% is funded by debt. What happened? Your fixed commitment now is very high. And when the company does not perform well and you're unable to make the interest payment, the higher the chances of the company going into bankruptcy risk. Okay, how does the company goes to bankruptcy risk? When you're unable to make an interest payment, all right, the banks will not keep quiet. They will send you warning letters first, then they will take legal actions against the company and they make the company to file for bankruptcy. All right, why? When you file for bankruptcy, you have to sell any remaining assets in the company. The money you get from disposing any assets of the company will be first used to settle the debt. All right, once a company is basically winding up, sell any assets remaining in the company, whatever the money you get, you first settle the debt holders. If anything remains, then you can give it to shareholders. All right, so that is the main disadvantage of debt. All right, even though the tax benefits is good, but if you're taking too much debt, you might end up closing down your company. All right, so that is the main disadvantage of debt. Okay, so you can ask, do we have the um, same disadvantage if a company is funded 100% by equity? It means what? If you don't pay dividend, can the shareholders make the company go bankrupt? Can they do that? Can they take legal action? All right, the answer is no. If a company is funded by 100% equity, only shareholders, if the company does not pay dividend, their shareholders cannot do anything. The reason is dividend is optional, it's not fixed, right? So this advantage is uh, only affects if the company takes debt. All right. Okay, let's move on to the next. Let's talk about optimal debt to equity ratio. So when a company have this debt equity ratio, we need to find the ideal range. So the ideal range depends on two things, two risks. One is business risk, another one is financial risk. All right. So let's look at business risk first. Risk faced by the company, all right? Risk faced by the company in a business, all right? Especially the operation point of view is what we call as business risk, all right? So what are the main effects? All right, the main effect for a company is uncertainty about the future operating income. So that is the business risk, right? Your your future operating income. All right. So for a company, those they're affected because of COVID-19. So what is the business risk? The business risk is they are uncertain of getting income. Right. So those in the hotel, in the tourism industry, their revenue making is very uncertain. Right? So uncertainty about the future operating income is what we call as business risk. How well we can predict the operating income. All right, if a company does not affect by, let's say for like COVID-19, those who are in the like the food industry, all right, those companies, all right, they can still predict the operating income because everyone, uh, whatever the problem is, still people still need to eat, so they can still able to predict the operating income. The business risk is not still low, right? But those companies in tourism, the hotel, their business risk currently, all right, very high. Okay, so uncertainty about future operating income is the business risk. And by looking at the diagram here, okay, this considers low risk, and the one here is high risk. Okay, why? They have categorized this as low risk and high risk. All right. If you look, this is the probability. This is the earning. Right. So if you look at the one with the low risk, the range is shorter. All right, the range is shorter. But the high risk, the range is longer. All right, the narrower the diagram is, the lower the risk. All right, the wider the diagram is, the higher the risk. All right, is like, okay, it's like your expected earning is, let's say, 1 million, right? But in reality you get 800,000. Okay, you wanted 1 million, but in reality get you 800,000. That is low risk. Okay, higher risk means you expected 1 million, but you only get 200,000. That means it is higher risk. The chances from what you expect and the result could be, if too different, that means high risk. Okay, if it's slightly different, that is considered low risk. Okay, it's like think about your, let's say for your exam, you wanted to get A, right? You expected your final exam, you want to get result A, but let's say you get A minus. All right, A plus, it's good. A minus, A plus, that means you are at the low risk. You expected A, but you get C or D. That is high risk. All right, so that is the probability of the outcome, right? So note that business risk does not include the financing effects, right? So you have to take note that business risk does not include how the company is funded, all right? How much equity, how much debt does not affect the business risk. The financing effect, we will look into the next risk, right? So what determines the business risk? Uncertainty about the demand. All right, the first one is uncertainty about demand. All right, your sales, those who can predict every month they are making 500,000 worth of sales. All right, they can predict for the next 6 months they're going to make 500,000 per month. Then your business risk is low. but you're not sure how much you're going to earn next month because of the certain situations. All right, that means your business risk is high. So the first one is uncertain, how much sales you're going to make next year, whether you're going to make sales or not, you're not sure. So that means that's a business risk. Second, uncertainty about the output price. All right, if you're sure you are selling a product at 5 ringgit, you know it's not going to change, then you have no business risk. But you're not sure. Next, the output prices or the selling price could reduce. You're not sure. So that is another business risk, right? You're not sure how much sales you're going to make. You're not sure how much you can sell a product. Uncertainty about costs. Again, you're not sure what is the cost going to be. All right, uncertain. And the next one, product, other types of liability, and then operating leverage. All right, so here you might need to take note. Your operating leverage is measures firms fix. All right, operating leverage is measures firms fix versus variable costs. All right, so if a company has higher fixed costs, that means it facing higher operating leverage. All right, I repeat, a company that having higher fixed costs will end up having higher operating leverage. See, let's take an example of the airline industry. The airline industry, the fixed cost is very high, all right, because the plane, all right, the aeroplane, it's a fixed lease. Whether you're bringing full capacity, half capacity, only 10% of capacity, you're still going to pay the full lease amount, right? What about the oil? All right, whether it's full capacity, half capacity, or 5% capacity, the oil that you're going to consume is still going to be the same, right? And same goes to the maintenance, same goes to uh, the people who work, the cabin crew or the pilot. Do you think if you bring only half capacity, you're going to use one pilot? No, right? You're still going to be having two pilots. So your operating leverage for in such industry is very high. All right. So that is why, previously when you compare with AirAsia and Malaysian Airlines, one of the reasons why AirAsia was doing well is because whenever if let's say you have taken a AirAsia flight, you would have seen the flight would have been mostly completely utilized. It means almost 90 to 100% of the seats has been occupied. All right, so it means maximum utilization of an asset. That means when they use the asset with the maximum capacity, they could able to cover their fixed costs and able to make profit. Compared to mass, when you're only occupying like half of the seats, or like maybe 20% of the seats, then you might not even cover your fixed costs. That is why the company is making loss. All right, so that is all about operating leverage, and that all this will affect a company's business risk. All right, so let's move on to the next slide. All right, so here we're going to talk about financial leverage and financial risk. All right, financial leverage means the use of debt and preferred stock or preferred shares. All right, whenever a company take debt or preference shares or preferred stock as the source of finance, then the company has financial leverage. Right? When the company uses debt and preference shares or preferred stock, it means the company has financial leverage. Okay, what about financial risk? When the company have debt, they have a fixed commitment. All right, fixed commitment means the payment of interest. All right, preference shares or preferred stock, you pay fixed dividend. So that is the fixed commitment for the company. For both of it, all right, you have to pay fixed commitment. So that's what we call as financial leverage. So financial leverage will give financial risk, which means, as I mentioned earlier, the disadvantage of the debt, which means if the company take more and more financial leverage, it will end up having higher fixed commitment. When I have higher fixed commitment, the chances of the company going bankruptcy is higher, all right? Because when the company making loss, they might not able to make their fixed commitment, therefore the company can go into bankruptcy. All right, so here say additional risk concentrated on common shareholders as a result of financial leverage. All right, so let me ask you a question. If a company is funded 100% by equity, means no debt, does the company have financial leverage? All right, I repeat my question. If a company is funded by 100% equity, will the company have financial leverage? The answer is no. Right? When a company is not funded by debt or preference shares, that means there's no financial leverage, no financial risk. When the company take, let's say 5% is funded by debt, 95% funded by equity, will the company face financial risk? Yes. All right. Whether 5% or even 1%, when the company takes debt, all right, then their financial leverage and of course can lead to financial risk. All right, so that is why it's stated here additional risk considered on common shareholders. All right, because without debt there's no financial risk. With debt, now shareholders have a additional risk, which is financial risk. Right, so let's move on. All right, so the difference business risk and financial risk. Business risk, remember, is uncertainty about the future income, uncertainty about the future costs. All right, so whether the company can survive, right? For a company to survive, they need to know they can at least predict their income, predict their costs, all right, predict their sales price and the fixed costs. So it all depends on what? So all those depends on business factors such as competition. See, when a company is monopolized in the market, like for example, last time you only had Astro, last time you only had Telecom. So you monopolize the market. So when there's no competition, you fix the selling price or the product price as what you wish, right? Because you monopolize the market. But now when you have competition, you have to give competitive price, right? And then you have product liability and also the operating leverage. So that affects the business risk. And the financial risk, of course, when you have more debt, more financial risk. No debt, no financial risk. All right. So it concentrates business on the shareholders. So remember, class, financial risk only affect when the company take debt. All right, so financing will lead to financial risk. All right, the difference of sorts of financing can lead to financial risk. Financing does not affect the business risk, right? All right, so let's take an example. Suppose 10 people decide to form a corporation to manufacture this rice. If the firm is capitalized only with common stock, and if each person buys 10%, each investor shares equally the business risk, right? So 10 people started a company, so each funded the company by 10%. So investor shares equally the business risk. Right, so whatever happened, Whatever happened to the company, 10 people will share it equally, 10%, right? So that is your business risk. If the same firm now capitalized with 50% debt and 50% equity, with 5 people investing in debt and 5 investing in equity, right? So now, previous example, 10 people funding the company by equity. So 10 shareholders, so each sharing 10% of the company's profit and also liability, right? But here is 50% equity, 50% debt. So what happened now? The 5 who put up the equity will have to bear all the business risk. Okay, for instance, previously the company, all right, if let's say the company made 100,000 loss, right? Made 100,000 loss. 10 people will share. 10 people will share the loss equally, which means what? Each will bear 10,000, right? Each will bear 10,000 loss. But here, the same company, let's say, but 5 people equity, another 50% is funded by debt, which means the same 100,000 loss, but now each of them, since only have 5 now, each have to bear 20,000 loss. Alright, so debt has already amplified the risk. Alright, with debt, the risk has been amplified. Of course, if you look at the bright side, is what? When the company is making profit 100,000, each is taking back 20,000, right? Previous example, only 10,000. So, of course, that's a benefit and the risk equally. The risk is you have to bear higher risk. Okay, so that is the example of business risk and financial risk. All right, higher risk I'm talking about for the particular person. All right, for the particular shareholders, you are facing higher risk. All right, so next, moving on. All right, so with another example, there's 2 companies, firm U, firm L. Firm U is unleveraged, firm L is leveraged, which means firm U has no debt with 20,000 assets, 40% tax rate. Here, 10,000 debt, which pays 12% interest, and 20,000 assets, 40% tax rate. So the only difference here is when the company has 20,000 in assets, 20,000 was funded by equity shareholders. All right, shareholders has funded the entire 20,000. Right, if you still remember the accounting equation, asset equals to asset equals to equity plus debt. All right, so asset, write the time. All right, okay, asset equals to equity plus debt. So here asset 20,000, no debt, therefore equity equals to 20,000, right? So here asset equals equity plus debt. Debt is 10,000, therefore equity has to be 10,000 as well. All right. So let's look at with 3 different probabilities. How does the company's tax portion is affected? Okay. 25%, the economy are predicted to be bad, 50% to be average, good is 25%. Okay, for each different probabilities, of course, the earning, all right, the earning you expect it to be different as well, right? So when the economy is bad, you're only making 2,000 profit, right? When average, it's 3,000. When good, when economy is good, of course, you're making higher profit. Okay, your taxes. Sorry, before that, do you pay any interest? Since the company which is unleveraged, no debt, no interest. All right, so this is earning before interest and tax. minus interest, this is earning before tax. So tax is 40%, which is 800. Therefore, your net income is 1,200. So for 3,000 you pay 1,200. For 4,000 you pay 1,600 interest. All right. So remember 800, 1,200, 1,600. Right. So that is the tax you pay when the company has no debt. But if the same company, all right, with the same amount of asset but funded by debt and equity. So let's look at the difference in the financial statement, which is 2,000, 3,000, 4,000 is the same, all right, with the difference of probabilities in the economy. If for 2,000, the interest, how much you pay interest? So class, remember, your debt is 10,000 and the rate is 12%. For 12% out of 10,000, your interest is 1,200. All right. So whether economy is bad, average, good, you still pay the same interest amount, so 1,200. So earning before interest and tax minus interest, your earning before tax is 800 now compared to 2,000 previously, and the tax is only 320. Right. So remember, previously was 800, now 320. Previous was 1,200, now 720, and previously 1,600, now is 1,120. All right. So this is the benefit of taking debt, because you end up paying lesser tax. All right. So this is to tell you how the effect when a company has equity without debt, and another company which has equity and also debt. All right. So class, here you need to take note. We're going to calculate ROA, return on asset, return on equity for both the companies, firm U and also firm L. Okay. So if you remember your the ratio, return on asset is net income divided by your total asset. All right, so that is return on asset. Net income divided by total asset. So return on equity would be same, net income divided by total equity. All right, so I'll give you an example for return on asset. When the company is bad, your net income is your net income is 1,200. All right, we're looking at the bad situation. The economy is bad. Your net income is 1,200 divided by your total asset, which is 20,000. All right, so 1,200 divided by 20,000. So what? How much do you get? You should be getting 6%. All right. For return on equity, your net income is 1,200. And what about your equity? What about your equity class? Your equity is when there's no debt, the company funded the asset entirely by equity. So again, the same 20,000. So 1,200 divided by 20,000. Again, you get 6%. Okay. So class, why don't you complete for the rest. For average, good. And for firm L, why don't you take a piece of paper, or if you already printed your notes, write the answers here. Alright, I'll give you some time. Write the answers, then we shall continue.